Inflation can erode your purchasing power, but with the right strategies, you can safeguard your finances and even thrive. Let's explore practical ways to protect your wealth from inflation's impact. First, consider diversifying your investments. Include asset classes that perform well during inflation, such as real estate, stocks, or inflation-protected securities like Treasury inflation-protected securities, TIPS. Diversification spreads risk and increases your chances of positive returns. Investing in commodities like gold, silver, or oil can also serve as a hedge against inflation. These tangible assets often hold value when currency purchasing power declines. Focus on building passive income streams. Rental properties, dividend-paying stocks, or even royalties from intellectual property can provide cash flow that offsets rising costs. Another strategy is to reduce high-interest debt. Inflation can increase borrowing costs, so paying down debt helps free up money for savings or investments. Consider adjusting your budget to account for inflation. Track rising costs and prioritize spending on essentials while finding ways to save on non-essentials. This keeps your financial plan adaptable. Enhancing your earning potential is another way to stay ahead. Invest in skills or education that increase your value in the job market. Higher earnings can help offset the effects of inflation. Finally, review your financial plan regularly. Inflation rates and economic conditions change, so it's essential to adapt your strategy to stay aligned with your goals. By taking proactive steps, you can protect your finances and navigate inflation confidently. In the next part, we'll look at future trends and predictions for inflation and how they might impact you. Stay informed, stay prepared, and turn inflation into an opportunity for financial growth. Inflation doesn't just affect prices, it also plays a significant role in shaping investment decisions. Understanding how inflation impacts your portfolio is key to protecting and growing your wealth. Let's explore the relationship between inflation and investments. When inflation rises, the purchasing power of money decreases. This can erode the real returns of investments like savings accounts or fixed income bonds with low interest rates. For example, if inflation is 3% and your bond yields 2%, you're effectively losing 1% in purchasing power. Stocks, on the other hand, can offer some protection against inflation. Companies may pass higher costs onto consumers, potentially maintaining or increasing their earnings. However, this depends on the industry and overall market conditions. Real estate is another asset class often considered a hedge against inflation. Property values and rental income tend to rise with inflation, preserving or growing the real value of these investments over time. Commodities like gold and oil are also popular during inflationary periods. These tangible assets often retain value when paper currency loses purchasing power, providing stability during economic uncertainty. Inflation-protected securities, such as Treasury inflation-protected securities, TIPS, are specifically designed to shield investors from inflation's effects. Their principal value adjusts with inflation, ensuring real returns remain intact. Diversification is your best strategy for navigating inflation's impact. By spreading your investments across different asset classes, you reduce risk and increase the likelihood of positive returns, even in inflationary environments. Understanding how inflation interacts with your investments empowers you to make informed decisions. In the next part, we'll discuss practical strategies for managing your finances during inflation and staying ahead of economic challenges. Stay tuned for more insights into thriving in an ever-changing economic landscape. Inflation doesn't happen in isolation. Central banks play a crucial role in controlling it. Their actions directly impact the economy, influencing prices, wages, and your financial decisions. Let's explore how central banks manage inflation and maintain stability. One of the primary tools used by central banks is adjusting interest rates. When inflation rises, central banks often increase interest rates to make borrowing more expensive and saving more attractive. This reduces spending and demand, helping to slow inflation. Another tool is controlling the money supply. Central banks may buy or sell government bonds to either inject money into the economy or remove excess funds. This helps regulate the amount of money circulating and keeps inflation in check. Inflation targeting is a common strategy where central banks set a specific inflation rate, often around 2%. By aiming for this target, they strive to create a balance that supports economic growth without allowing prices to rise too quickly. Communication is another powerful tool. When central banks announce policies or future plans, it shapes expectations. For example, signaling a rate hike can influence businesses and consumers to adjust their spending before any changes occur. However, managing inflation isn't without challenges. External factors like global supply chain disruptions or geopolitical events can make inflation harder to control. That's why central banks constantly monitor economic data and adjust their strategies accordingly. Understanding how central banks manage inflation helps us appreciate the delicate balance they maintain to support a stable economy. In the next part, we'll explore how inflation affects investments and what you can do to protect your portfolio. Stay tuned for more insights into navigating inflation and its impact on your financial future. While moderate inflation is a normal part of a healthy economy, hyperinflation is an extreme and dangerous phenomenon. It occurs when prices rise uncontrollably, eroding the value of money almost overnight. Let's explore what causes hyperinflation and its devastating consequences. Hyperinflation is typically driven by two main factors: excessive money printing and a collapse of trust in a country's currency. When governments print vast amounts of money to cover deficits without backing it with economic growth, prices spiral out of control. This happened in Zimbabwe in the late 2000s when inflation reached 89.76 billion%. Another example is post-World War I Germany, where the government printed money to pay war reparations. This led to soaring prices, with people needing wheelbarrows full of cash to buy basic goods like bread. The consequences of hyperinflation are severe. Savings become worthless, and people lose trust in their currency, turning to barter or foreign currencies instead. Daily life becomes a struggle as wages fail to keep up with rising prices, and businesses shut down due to unstable costs. Hyperinflation also destabilizes economies and societies, leading to political unrest and widespread hardship. It's a stark reminder of the importance of sound monetary policy and economic management. Fortunately, hyperinflation is rare and usually preventable with responsible fiscal and monetary policies. In the next part, we'll discuss how central banks manage inflation to maintain stability and prevent scenarios like this from occurring. Understanding hyperinflation helps us appreciate the delicate balance required to keep economies healthy and the importance of safeguarding our financial systems. Inflation may seem like an abstract concept, but its effects are very real, and they touch almost every aspect of daily life. Let's explore how inflation impacts your finances, choices, and future. First, inflation affects purchasing power. As prices rise, your money buys less. For example, groceries, fuel, and other essentials may cost significantly more over time, stretching household budgets thin. Savings can also lose value during inflation. If the interest rate on your savings account is lower than the inflation rate, the real value of your money decreases. This is why it's important to explore inflation-protected investments or strategies that help your savings grow. Inflation impacts wages too. While salaries often rise to match inflation, they don't always keep pace. This means that even with a raise, you might feel like you're falling behind as costs increase. For businesses, inflation raises production and operational costs. To compensate, companies might increase prices or reduce product sizes, a phenomenon known as shrinkflation. Housing is another area where inflation is felt. Rising prices can make it harder to afford rent or buy a home, while existing homeowners may benefit from appreciating property values. On a larger scale, inflation can influence government policies, such as interest rate adjustments by central banks. These decisions can trickle down and affect borrowing costs for mortgages, loans, and credit cards. Understanding how inflation affects your daily life empowers you to make informed financial decisions. In the next part, We'll explore historical examples of extreme inflation and what lessons they hold for managing its challenges today. Inflation doesn't just happen, it has underlying causes that drive price increases. Two major types of inflation are demand pull and cost push inflation. Let's break them down with examples. Demand pull inflation occurs when demand for goods and services outpaces supply. Imagine a new gadget becomes a must-have and everyone rushes to buy it. Companies can't produce enough to meet the surge in demand, so prices rise. This type of inflation is often linked to economic growth and increased consumer spending. Cost-push inflation, on the other hand, happens when the cost of producing goods and services rises. For example, if the price of oil skyrockets, transportation and production costs increase, causing businesses to charge more for their products. This type of inflation is usually tied to supply chain disruptions or rising input costs. Both types of inflation can happen simultaneously. For instance, during a natural disaster, demand for certain items like food and water may spike, while production and delivery costs also increase due to damaged infrastructure. Understanding these causes helps us see why inflation can feel so unpredictable. Factors like consumer behavior, production challenges, and even global events all play a role in driving inflation. Stay tuned as we explore how inflation impacts your daily life and what you can do to navigate these challenges. Knowing the causes is the first step to staying informed and prepared. Inflation is a term we hear often, but what does it actually mean? At its core, inflation is the gradual increase in prices over time, which reduces the purchasing power of money. Let's break it down simply. Imagine you could buy a loaf of bread for $1 last year, but today it costs $1.10. That's inflation, prices rising over time. While a small amount of inflation is normal and even healthy for an economy, too much or too little can cause problems. Inflation is often measured using tools like the Consumer Price Index, which tracks the prices of everyday goods and services. When prices rise consistently, it's a sign that inflation is at work. But why does inflation happen? It can be caused by an increase in demand, more people wanting goods and services than the economy can supply. This is called demand pull inflation. Alternatively, it can result from higher production costs, like wages or raw materials. This is known as cost-push inflation. While inflation might seem like a distant concept, it directly affects your life. It can influence the cost of groceries, rent, and even the value of your savings. Understanding inflation is the first step to managing its impact on your finances. In this series, we'll explore what causes inflation, its effects, and how you can protect yourself from its challenges. Stay tuned as we dive deeper into the world of inflation and discover ways to stay ahead in an ever-changing economy. Inflation is a constant in the global economy, but its future trajectory is shaped by a mix of trends, policies, and unforeseen events. Let's explore some potential trends and predictions for inflation in the coming years. One major factor influencing inflation is technological advancement. Innovations like automation and artificial intelligence can increase productivity and reduce costs, potentially keeping inflation low in certain sectors. Globalization is another key player. As supply chains connect more countries, competition keeps prices in check. However, recent disruptions in global trade highlight vulnerabilities that could lead to inflationary pressures. Energy transition is a trend to watch. Shifting from fossil fuels to renewable energy sources requires significant investment, which could drive up costs temporarily before stabilizing over time. Central bank policies also play a pivotal role. Efforts to stimulate or cool economies through interest rate adjustments will directly influence inflation rates. For instance, aggressive measures to curb inflation might slow economic growth in the short term. Geopolitical events and climate change add layers of uncertainty. Wars, trade disputes, or natural disasters can disrupt supply chains and create inflationary shocks. Digital currencies, such as Bitcoin and central bank digital currencies, CBDCs, may reshape how inflation is measured and managed in the future. Their adoption could bring new dynamics to the global financial system. Predicting inflation isn't an exact science, but staying informed about these trends can help you make proactive financial decisions. By understanding the forces driving inflation, you'll be better prepared to adapt and thrive. This concludes our series on inflation. Thank you for joining us on this journey through one of the most important economic topics of our time. Stay tuned for more insights to help you navigate the financial landscape with confidence.